Okay, so you want to know if Tesla's stock price is headed higher or if it will crash. You want to know if Tesla is about to be included in the S&P 500. But most importantly, you want to know what effect Tesla joining the S&P 500 would have on Tesla's stock price. Would the extra buying power send the stock even higher? Or has it already been priced in and it could actually lead to a crash? So first things first, I don't have a crystal ball and I'm not a financial advisor. So what I'm going to do in this video is just present my research to you. We'll be looking at both arguments, positive and negative for Tesla's stock price, including a really interesting research paper which looked into the effects of what happens when a company joins an index, but specifically what happens when a larger company, something like Tesla, joins an index. Because remember, this is quite a unique situation. Most companies join the index right near the bottom, but Tesla could actually be joining as a top 20 company already. So let's get straight into it. So the S&P 500 is basically a basket of America's 500 largest companies. And there are funds out there who allow us to invest into all 500 of these companies very easily. Essentially, the fund goes out and buys shares from these 500 companies and then bundles it together in one easy to buy package for us. So the reason the Tesla being added to the list of 500 companies is a very big deal is because it means each one of those funds would have to go out there and buy Tesla's shares. This increased demand could, in theory, of course, lead to a higher price. With these funds having around $4.4 trillion under management between them, it wouldn't be a small amount of money either. And these funds literally won't have a choice if Tesla is added to the list, because the entire purpose of these types of funds is that they simply contain those 500 companies. They don't pick and choose based on valuation or anything like that. If Tesla is added to the S&P 500, these funds will hold Tesla shares. So to put this into perspective, let's look at how many shares would be purchased to give us an understanding of how big the demand from this could well be. Well, according to Ivan Kajic, head of index and ETF research of Virtu Financial, he estimates index managers would need to own roughly 25 million Tesla stock. To give you some context, there are currently 147 million stock publicly available. So this is a whopping 17% of Tesla's floating stock. Okay, so we can see from this why people are so excited about Tesla being added to the S&P 500. But let's wind it back for a second and ask ourselves, why aren't they included in the first place? After all, they're already in the top 20 companies in America based on valuation. So why aren't they included in the list of the top 500? Well, you see, companies have to pass certain requirements in order to join the list. They must have a market cap of at least $8.2 billion. They must have headquarters in the United States. They must have the value of the company's market cap trade annually. At least 250,000 of their shares must trade in the previous 6 months. Most of their shares must be in the public hands. And there must have been at least a year since their IPO. Now, Tesla checks every single one of these boxes. It is the last category which Tesla has yet to complete. You see, to be included in the 500, the sum of the previous 4 quarters of earnings must be positive, as well as the most recent quarter. Well, on July 22nd, Tesla will be sharing their earnings for the most recent quarter. If it's positive, Tesla will have finally met all of the necessary criteria for a listing. And there are reasons to believe it will be positive too, with Tesla reporting second quarter deliveries of 90,650, which impressively is up 2% compared with the previous quarter, in spite of some pretty major disruptions occurring in the world. So there are reasons to believe that Tesla will qualify for the S&P 500. And if it doesn't happen this time around, many analysts are predicting that it could be just a 3-month longer wait until Q3 to see the same outcome. Okay, so I think we can see a pretty bullish picture forming here. We have one of the most innovative, groundbreaking companies in the world who build pioneering technology, combined with a potential listing to a market worth $4.4 trillion. And I don't know about you, but I'm a pretty big fan of the cars. But I said at the start that I would present both the positive and the negative perspectives that I've found through my research. So let's take a look deeper. So the first potential negative being raised by analysts relates to the global situation and the possibility that California may have significant lockdowns, as we're kind of seeing already. As noted, California is far and away Tesla's largest market. If California is being forced to shut down again, there are going to be a lot fewer people looking to buy new vehicles. Now, if we look at Tesla's price chart for 2020, it has been crazy. While the underlying performance of the company has been very impressive considering the tough times, I think it's fair to say that at least a decent chunk of the most recent price increase has probably come from the hope and perhaps expectation that Tesla will be added to the list of the 500 companies, the S&P 500. So the question is, what happens if they don't meet the criteria this quarter? And what happens if the lockdowns and global situation affect their earnings, and so they don't meet the criteria the following quarter either? Now, when it comes to markets, they usually price the likelihood of something happening into the stock. So if there's, say, an 80% chance of something happening to a made-up company, let's say company A, the stock might not actually fall that much when the bad thing eventually happens. Because the truth is, the market already expected it. So the market already priced this into the stock. So the question for Tesla is, what likelihood is the market pricing into the possibility of Tesla being added to the S&P 500? Is it a 50% chance? Is it a 75% chance? Or is it even higher? The truth is, it's impossible to know, but it looks to me at least that the market seems very confident that Tesla will be added to the 500 companies. And to be honest, it probably will happen, but as an investor, you always have to consider the worst case scenario too. What happens if Tesla doesn't meet the requirements, even if you think it is a low likelihood? So Tesla must first meet the necessary requirements to be listed. Once they've managed this though, they aren't automatically added. A panel of individuals meet up and they make the final decision of whether a company is added or not. Now, I tried to research this panel to see if there is any possibility that they could decide to maybe hold off adding Tesla's shares because maybe they think the volatility is too high or something. I don't really think it's their place, but I wanted to research this to see if that was a possibility. But all I could find was an objection in the past relating to Snapchat and creating a new class of shares. I couldn't find any reason which would indicate that the panel would say no to Tesla based on something like volatility, but I wanted to include it here for you anyway, just to be thorough. Another question I was wondering is, what if the funds who would have to buy Tesla shares have already bought them? If they have, then it would of course mean that these funds wouldn't have to buy the shares later down the line. Well, I found this comment. Being added to the S&P 500 index certainly would be quite an accomplishment for any company, Tesla included, but I'm not sure how big it would be for the stock. Baird managing director and trader Greg Gaynor tells Barron's, there is typically a bump in demand from funds upon inclusion, up to 25 million shares in the case of Tesla. It's just a question of how much of that has been pre-traded. Index funds are rarely caught completely off guard, meaning today's rally could be tomorrow's index inclusion. The article goes on to note the Vanguard S&P 500 and the Spider 500, two big index funds for instance, would need to purchase about 3 million Tesla shares to get up to the appropriate weighting, and they are two of many index funds. The amount of stock to buy matters, but so does how Tesla stock trades. Tesla shares are very actively trading. Volume averages around about 11 million shares a day, so the index effect, based on Gaynor's rough figures, represent about 2 to 3 days of typical volume. That isn't all that much. Having a more liquid, rapidly trading stock makes any potential indexing impact smaller. Okay, so I don't really agree with the statement of it only being 2 to 3 days of typical trading volume. Whereas 2 to 3 days of standard trading is both buying and selling, this indexing effect would only be buying power. But of course, it is true that with a more traded stock, any extra buying power does have less of a price impact. And what I found particularly interesting from this is the possibility that funds could have already purchased shares. If that's the case, it could actually explain why the price has shot up so much recently. Maybe that was the funds buying already. If this is to be believed, then it could mean people are banking on funds buying shares in the future, but unbeknown to investors, there might not be a need for those funds to buy shares in the future. Now, to be honest with you, I don't really understand how this works from a practical perspective. If their goal is to just match the index, then surely buying early means that they won't, because they'll be holding a stock which isn't yet in the index. And what happens if Tesla didn't get listed this quarter? Would they just have to sell the stock because after all it's not in the index? And if they did and it dropped in price, who would pay for that lost value? Although that's just my thoughts, and I'm sure there could be ways around what I just said. Now I want to show you this study published on the National Bureau of Economic Research, which analysed what happens when companies join an index, and importantly, how this affects the stock price. And what's really interesting about this particular study is that it more accurately reflects the situation with Tesla than any other study I could see. Tesla is already in the top 20 largest companies in the United States by valuation, so it will be joining the index right near the very top. Whereas when most companies join an index, it's because they've just crept over the necessary valuation. So most companies might enter somewhere between position number 400 and 500. And as a result, when you research studies looking at the effect on a company when it joins an index, most of the examples are of companies that join quite low down in the rankings. And this isn't really representative of what could happen with Tesla. So this study is particularly interesting as I think it reflects Tesla's situation more accurately. So let's take a look. Past studies have found that companies added to the S&P 500 experience increases in their share values, and yet recent studies with the largest samples also have shown that there are no corresponding declines in share values when firms are deleted from that index. So in other words, companies seem to benefit when they're added to an index like the S&P 500, which makes sense of course, as the index funds would have to go and buy their shares, and that means more demand. But companies don't seem to be adversely affected if they're removed from the index, which is very strange as the funds would be selling their shares, so you'd expect this might push the price down. Well, that seeming paradox has led some to conclude that the share price increases might not only be tied to buying by passive stock index funds or institutional investors who are benchmarked to various indexes. Rather, the spike in share prices might be associated with an increase in earnings forecasts and improvements in realized earnings at the same time a firm is added to an index. Also, some scholars have theorized that lingering investor recognition of firms that were once on an index may partially explain why their share prices don't fall after deletions. So, in other words, the increase in price when a company is added to the index could be more because the company is just doing well financially, so investors are paying more attention to it. And the fact that companies which are removed from the index don't lose value could be because investors know the company well and so they continue to follow it even after they are removed from that index. But the researchers wanted to look at this theory and test it using data, which applies pretty well to situations like Tesla. Basically, they looked at two market indexes, the Russell 1000 and the Russell 2000. I've created a little graphic to help you visualize this, but I'm really no expert on Photoshop or anything like that, so just bear with me here. So the Russell 1000 is an index containing America's top 1000 most valuable companies. The Russell 2000 contains the 2000 companies below this. So in other words, the companies between positions number 1001 and 3000. As companies grow and shrink, they're naturally going to be moving back and forth between these two indexes. But here's the thing. Let's say a company is ranked 1100th and they have a few good months and climb up to 990th. As they're in the top 1000 now, they'll have moved up to the Russell 1000 index. But they won't have much impact on that top index. After all, the index contains the likes of Apple, Amazon, Facebook, etc. So this company is only going to represent a tiny fraction of the overall pie. But now let's imagine this company then had a bad few months and they dropped out of the top 1000. Let's say they fell to position number 1005. Now this is very different. The company will rejoin the Russell 2000 index, meaning those funds will have to buy this company's shares again. And because it's the 5th largest company in that index, it means those funds have to commit a pretty significant proportion of their overall money to buying those shares. As the study notes, because the indexes are capitalization weighted, there is relatively little index buying when a firm enters the Russell 1000 as one of the smallest firms. But there is non-trivial buying when a firm joins the Russell 2000 as one of the index's largest firms. Indeed, the authors found the index weights for the stocks in the Russell 2000 just below the 1000 cutoff are around 10 to 15 times larger than the index weights for stocks just above the 1000 cutoff. So this research is particularly interesting because it looks at what happens when a company joins an index as one of the largest companies within that index. And again, Tesla is one of the rare exceptions in that they are already an extremely valuable company before joining. And the research showed that there is non-trivial buying when a firm joins the Russell 2000 as one of the index's largest capitalized firms. So this is of course a bullish signal for Tesla. But I would add that the research generally on what happens when a company joins an index and for months afterwards, it's really quite mixed. So I wouldn't take this as a uniformly bullish sign. A few articles at the moment are throwing around the example of Yahoo back in 1999, but I chose not to include that for this video because I think it's just silly to really use a one-off example, and especially during the dot-com bubble. Now, I've done my best to keep my opinion out of the video so far and just present my research to you, both the positive and the negative perspectives, but I will share my personal thoughts with you. I might not be right, I might be entirely wrong, so no worries if you don't agree, but this is just what I personally think. I think Tesla is an incredible company, and they're not just a car company either. What makes them so interesting is that they are the intersection of a few different industries, and that's why it's so difficult for anyone to place an accurate valuation on them. But I can't help but feel like there could be more downside risk in the short term than upside potential. If we look at Tesla's price chart, I'll be honest, it puts a bit of fear in me, looking at how quickly the valuation has climbed. And I suspect that the market may have already priced in Tesla being added to the S&P 500. So I think it could be a classic buy the rumor, sell the news situation. But hey, that's just my opinion and I might be totally wrong. For me, it all comes down to how much you're investing. As we've seen, Tesla is one of those stocks that can gain or lose huge amounts in just a matter of weeks. If someone is 100% invested in Tesla, boy, that's a lot of risk. But if someone has invested a reasonable amount as part of a well-diversified portfolio, then they've already planned for the potential of the stock price going higher because, of course, they hold the stock. And they've prepared themselves for downside risk through diversifying. So that approach would make a lot more sense to me. I'm keen to hear what you think. And most importantly, let me know in the comments if you're invested in Tesla and if you think it's going higher or lower. Do you think this has already been priced in, or do you think this is going to be extra buying power? And what kind of price target do you have? And before you go, don't forget to check out this video up here. And of course, just thank you for watching.